Hello and Assalamualaikum. My name is Sarah Shahira binti Muhammad Sofian from JBA 1145E. In this video, I will explaining about the advantages and disadvantages of investing in preferred stock. But before we get into that, I'll first define what is preferred stocks. Preferred stock is a different type of equity that represents ownership of a company and the right to claim income from the company's operations. Preferred stockholders have a higher claim on distributions than common stockholders. The current issue with preferred stock in 2024 is their sensitivity to interest rate changes. Morgan Stanley reports that with higher interest rates, investors may see more volatility in preferred stock prices as the securities often decrease in value when rates rise. This trend creates a challenging environment for preferred stockholders who rely on these assets for income stability. So now, let's jump into the subtopic that I mentioned earlier. First, I'll start with the advantages of investing in preferred stocks. So first is higher dividend yields. Its preferred stockholders typically provide higher fixed dividend yields compared to common stocks. This regular income can be attractive for investors seeking stable cash flows, especially in low interest environment. Secondly, priority in dividends and liquidation. Preferred shareholders have priority over common shareholders when it comes to dividend payment. In the event of a company liquidation, preferred stockholders are paid out before common shareholders, though they still rank below bondholders. And lastly, low volatility than common stocks. Preferred stocks generally experience less price volatility than common stocks as their prices are more stable and closely tied to the yield they offer rather than the company's earning growth potential. This can make them appealing during times of an economic uncertainty. While preferred stocks offer attractive benefits, they also come with several disadvantages. So first is interest rate sensitivity. Preferred stocks are particularly sensitive to interest rate changes. When interest rates rise, the value of preferred stocks tends to fall because new bonds and fixed income securities become more attractive, offering higher yields than older preferred stock issues. This can lead to significant price volatility and capital losses for investors. Next, limited growth potential. Unlike common stocks, preferred stocks do not typically benefit from company growth in terms of share price appreciation. Preferred stockholders usually do not share in the company's profit beyond the fixed dividend payments, meaning there's minimum potential for capital gains, which limits long-term growth potential. Lastly is dividend payment risk. Preferred stock dividends are not guaranteed and can be skipped, especially if they are non-cumulative. In times of financial difficulty, a company may suspend dividend payments on its preferred shares, impacting income-dependent investors. This risk is heightened in economic downturns when companies might cut dividends to conserve cash. In closing, I hope this presentation has been insightful. Thank you.